Hello traders, welcome to ForexLia. Today we are breaking down a really fascinating candlestick pattern that can signal a big change in the market's direction. It's called the homing pigeon and it's a powerful tool, but only if you know exactly what you are looking for. So the homing pigeon, you got to love the name, right? It actually comes from this idea of a pigeon finally returning home after a really long flight. And that's the perfect metaphor for what these patterns suggest, the end of a long downward journey for a stock price. Alright, here's what we are going to cover. We'll look at what the signal means, the anatomy of the pattern itself, how to confirm it, which is crucial, how to actually trade it, and then we'll wrap up with 4 rules you absolutely have to remember. First things first, where do you even look for these things? Because with chart patterns, let me tell you, context is everything. You can't just support this pattern anywhere and accept it to work. The key things to get here is that this is not some random formation. You should only be hunting for a homing pigeon after an asset has been in a clear downtrend for a while. It's like the market is starting to whisper that the sellers are just running out of steam. And the cool part, this applies everywhere: stocks, forex, commodities, you name it, and on any time frame from a 5-minute chart all the way up to a weekly. Okay, so let's get into the nitty-gritty. What does this pattern actually look like? It's all about the very specific relationship between just two candles. Okay, picture this first. You get a big long red candle. This show the sellers are completely in control, a really bearish day. Sometimes this can even be what's called a bearish Marubozu, which is a candle with basically no wicks at all, showing just pure, relentless selling. Then, the very next day, you get another red candle, but this one is smaller, and here's the key: its entire body is contained within the body of the first big candle. It's like it's talking away, finding shelter inside the previous day's move. Now, this is where you can really start to read the psychology of the market. Think about it. A tiny little second candle means the sellers trade to push the price down again, but they just couldn't make any real progress. That show massive indecision and a serious drop in selling momentum. It's the perfect step for buyers to start thinking about stepping in. So you've supported the two candles pattern is textbook perfect, and right here these where so many new traders jump the gun and make a huge mistake. The chart looks great, the downtrend was long, the pattern is crystal clear. So is it time to hit that buy button? The answer is an absolutely unequivocal no, and I really can't state this enough. If you act on the pattern alone, you are not trading, you are gambling, you are just hoping it works out. A professional trader always waits for the market to prove that the signal is the real deal. So what are you waiting for exactly? You are waiting for candle number 3. This is your proof. When that third candle closes above the high of the first big red candle, that's the market telling you that the buyers have officially wrested control away from the sellers. And hey, if you see the market gap up on the third day, opening way higher than the previous close, that's an even more expressive sign that the trend is turning. Okay, you've got your confirmation. The signal is real. Now it's time to start planning the trade itself. Let's talk about where to get in, and just as important, where you'll get out if you're wrong. This table less is out perfectly. Your entry is triggered only after that third confirmation candle closes, not a second before, and your stop loss that goes just below the low of the entire two candle pattern. This is so important because it defines your exact risks before you even enter the trade. If the price drops below that point, the pattern is failed. and you get out with a small, manageable loss. Alright, let's boil this all down into the absolute must follow, non negotiable rules. Think of this as your final checklist. If you take anything away from this explainer, make it these 4 points, just 4 simple rules. That's it. Get this right and you'll filter out almost all of the fail signals. Let's run through them. Here we go. Rule 1. The inside job. The second candle's body has to be completely solved by the first number weeks. No part of the body is taking out. Rule 2. Confirmation is mandatory. You always wait for that third candle to close higher before you even think about buying. Rule 3. Remember, the first candle has some flexibility. It can be a normal long red candle or that super bearish Marbuzo we talk about. And finally, Rule 4. Size matters. The tinier that second candle, the more powerful the signal. Treat this rule like a pilot's spare fight checklist. If even one condition it's met, it's not a valid pattern. You just move on, no exception. Okay, one last thing people always ask, what about volume? Do you need to see a big spike in trading volume for this signal to be valid? Well, the scores material we look at points out something pretty interesting here, and this is really key nuance. You think that you'd absolutely need to see York surge of buying volume on that confirmation candle, and will that's great. It's not a deal breaker for this specific pattern. The homing pigeon can and often does work well even on lower volume. The main things to focus on is the price action, the story the candles themselves are telling you.